good day and welcome to the Jain Irrigation Systems Q1 FY2024 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ashwath Rajan from KR Choksey. Thank you, and over to you, sir.
Thank you, Zico. Good afternoon, everyone, and welcome to Jain Irrigation Systems Limited earnings call. To discuss the Q1 FY24 results, today we have on call Mr. Anil Jain, CEO and Managing Director, and Mr. Bipin Walame, CFO. We must remind you that the discussion on today's call may include certain forward-looking statements that may involve known and unknown risk, uncertainties, and other factors, and must be therefore viewed in conjunction with the risk that the company faces. Future results, performance, or achievements may differ significantly from what is expressed and implied by such forward-looking statements. Please note the results and presentations are available on the exchange and our company's website. I now request Mr. Anil Jain to take us through the company's business outlook and financial highlights, subsequent to which we will open the floor for Q&A. Thank you, and over to you, sir.
Good afternoon to all. We would like to welcome you to our conference call. The quarter which we just completed and for which we are discussing results has been a very good quarter for the company, I believe. Overall revenues are up 20%, almost to the tune of 17 billion rupees. And that's quite an improvement considering the fact that we do not have the overseas businesses anymore linked to the irrigation business, which got merged with Revelis in March quarter. So that's a good solid number in terms of revenue growth. And in line with the 20% revenue growth for the whole company, our EBITDA has also grown. While revenues grew 20%, EBITDA has grown close to 26% from 180 crores to 227 crores. And registering good margin growth at about 13.4% at the company level. When I look at the individual divisions within this business overall, the high-tech division, which comprises drip irrigation, micro irrigation, and tissue culture business, did slightly almost same as last year, a little bit lower by 3%. And that was primarily driven by the fact that the project business, and I think we have said, we have informed the market that company is not taking the new projects, only completing the existing projects. And that project business went down by almost about 50%. So even though we had strong growth in standalone market in high-tech, where normal drip irrigation business grew by strong 20%, tissue culture business with additional capacity grew by 44%. Overall division has shown a minus 3% because of 50% reduction in projects. But our major focus now is on retail, so that is showing good results. The plastic business is significantly up between what we do in India in terms of the pipes, which go into for agriculture application, also for drinking water under Jal Jeevan Mission, and our plastic sheet business, which is there overseas. So overall, that business has grown almost 73% from about 4 billion rupees to 7.2 billion rupees. So that's a significant positive growth in the plastic business, and we have good level of orders and momentum where we see in the rest of the year and going forward this would remain very strong at these levels. Agro processing business, which is third piece of the overall company, slightly grew about 1.4%. Primarily the reason the higher growth is not there because last year in last season, which is last like July, May mango season in 22, there were not enough mangoes available. So we processed much lower quantity, and what we process then gets sold over next, 12 to 18 months. And so we had less material to sell because we just couldn't process last year. And therefore, while we grew the onion business, onion dehydration, there we had 9% growth. But the fruit pulp business did not really grow. And our overseas subsidiaries, they also were positive, in single digit. But then that's how you see 1.4%. But all in all, this season for the mango, we have done well. So I think overall double-digit growth should come back to this business, I believe, on annual basis, even though in the first quarter you may see that it is low single-digit growth. So overall, when you look at the entire business, good show in all divisions, with the difference of degree. But I think momentum and the direction is momentum is strong, direction is right. Businesses are going where we would like them to grow in total. Now, when we look at individual businesses, the question is where did growth come from? So if I look at even MIS business or drip business, this I'm more now talking standalone. These numbers which we had talked about were Concall. But if I look at standalone India, which is, the major input on the drip and the pipe business, the high-tech business was minus 2.4%, and plastics doubled itself to about 100%. Now, when we look at MIS business, where did it grow at 20% growth? So I think South was quite solid for us at about 28% revenue growth. West grew also 72%, North grew 24%, East was 51%. Maharashtra was neutral, so that is what it, due to part seasonality issues in Maharashtra, which we expect Maharashtra would also do quite well in the remainder of the year. And that is how we ended up at about 20% growth coming out of the MIS 20% growth was. So a lot of regions are doing quite well, and our focus on building dealers and reinvesting into dealers and into relationship, all of that is giving very good results. When you look at piping business, plastic pipe, where we have done quite well domestically, retail pipe business has grown almost close to 46%. And there, the major growth actually was provided by Maharashtra. Maharashtra grew 90%, even West grew 39%, but North and East had a negative growth. So again, it's a mixed bag there, but overall 46% growth, very robust, very good. We also had a good institutional business, and part of this goes into Jal Jeevan Mission, and part of this goes into other infrastructure projects in the country. And that business actually grew almost 700%, from 32 crores to 252 crores. So significant growth on the institutional and infrastructure side. Very good growth we had achieved in this quarter. So when I combine all of this and look at different geographical zone, how we are doing. So I think overall, if I look at domestic revenue, Maharashtra grew 40% for us. Southern, 4 states grew 11%. West comprises of Gujarat and Madhya Pradesh for us. That grew 63%. So major growth has come from, I would say, West and South. Overall, we would expect even North and East to contribute for the whole year, but first quarter, they were neutral, is what I would say. And institutional business, as I said, had a whopping growth. So that's in terms of different aspects of the business, in terms of where did growth come and how secular growth is. And we are very confident of maintaining these things going forward overall. Just to touch base that while you see, India growth overall revenue at 33%, in fact, if we are comparing to the last year, various resin prices actually have come down. So volume growth was even higher. In MI's business, volume growth was similar, 15-20% to revenue growth. But last PVC pipe business, we grew 96%. Polyethylene, we grew 400%. So overall, volume growth was closer to 90%. Because of reduction in the values and raw material prices, you don't see that captured. But overall, quite high from where we were and where we are now. So good volume growth, good value growth, good growth in most of Western and Southern India across dealer market. Very strong growth on the infrastructure and institutional side, and that is what has created this good result. And the momentum is quite positive in terms of where we are. Now, these numbers have resulted, as I said, in good revenue, top line, good bottom line. And overall, as a company, if I look at in this quarter, we generated about 150 crore rupees of cash from operating activities. So this is after the working capital change. So before working capital change, operating profit from operations was about 225, and then we have generated post-working capital changes 152. Part of the working capital changes where you see increase in inventories is linked to seasonality in the business, like we process a lot of mangoes or other products as a company during this period of time. So you would see that trade receivables have come down, the inventory has gone up, but still post these working capital changes, we have still generated cash of about 152 crores, and about 22 crores has been spent on mostly maintenance capex across the group, across the world, which is in line with the anticipation overall. Order book is good, close to almost 2,000 crores across. Some of our businesses have traditionally, the institutional business, depends on order book going forward. Food business has annual contracts, so also we usually get a good order book. But the piping and drip irrigation business, where most of the orders come from dealers on a weekly, daily basis. So when you look at the order book, that does not necessarily show how much company is going to do in the remainder of 9 months, because this order book does not contain the normal orders which will keep coming from the dealers. The other point to be noted is that, and which I had explained last time, that every quarter is not same for the company. For example, Q2 is the lowest amount of sales which we achieve compared to, let's say, Q1 or Q4, because this is a rainy season, and during rainy season, you hardly sell pipes or irrigation system. Business comes down drastically. But whatever we have seen of the July, I think we have grown, more than the last year. So I think momentum is there and will be maintained in the remainder of the year also. Now, in terms of debt and the balance sheet, I think structurally we have repaid some long-term debt already in the first quarter. Even though some of the working capital debt might be higher because of, again, seasonality impact, but I think we are sticking to our target that this year we're going to reduce the overall debt by almost 6 billion rupees or 600 crore rupees, while business should grow about 30%, whatever we have talked about. The industry, I believe, has tailwind. We recently had good dealer meets and so on, and the response is quite positive. The dealers are feeling confident about their customer base, that is the farmer, and they're committed, they're to continue to grow, and this is partly what we are doing is taking market share. So we are dynamic, real time in the marketplace in terms of our response to what's happening. And also our dealers are well enthused to move forward to, gain back some of the market share we lost between 19 and 22 period on one hand. But on other hand, also go into the new geographies, get part of the new business being created. As you saw our numbers, and if you have been studying historically, business has been strong in West and South, and we are now making sincere efforts to grow in North and East as well. And first it would be North, I think this year and next year, and then even East will, we believe, will join, because more and more farmers are understanding that drip irrigation and the solutions which provide, it is not just about saving water, but it is about improving production, productivity, and ultimately their income. And overall as a country, as we are going through this very silent revolution, where there is value-added agriculture is being done. So Jain Irrigation's products and solutions play a very important role in that process. And I think that this is a long-term story, right? This is not a 1 year, 2 year. This is a 5, 10, 20-year story, and that will continue to play. We as a company, I think we have good level of production capacity still left, where we can, manage growth without much of an issue. Order book goods, order book looks good. Momentum is positive. Overall industry is doing well. So I think this augurs well as we move forward. And as we, do more production, more sales, cost absorption, fixed cost absorption will continue to play out, which would allow us to, even further improve margin in some of the product segments which are there. And so that we can maintain our financial objectives in terms of trying to bring down the leverage and continue to focus on the dealer business, where we try and bring down the overall working capital. As you know, that working capital, and that is a part of our investor presentation, we are consistently bringing down the overall working capital, now in terms of days outstanding against sales. But, for some people it may still appear that the numbers are still high overall, even though they are coming down. Especially in standalone, you would see last year, June 22, net working capital was at about 294 days. Now it is 228 days. So over a year, that has significantly come down. Even compared to March, it is lower. And this would continue to happen. But partly this gets reflected that we have some legacy receivables coming from the project, etc., right? So that is going to get addressed between now and next fiscal year. So as that gets addressed more, and we are doing just more and more dealer business, dealer and institutional business, then if I really break down my receivables today, might appear they are quite high overall, it's about 6 months because of this legacy receivables being there. But if I really look at just the retail receivables, they are closer to 40 days. That is, in institutional business, we have to give up to 90 days credit, and the retail business, that's a zero credit. So combined, based on, the weightage, it is coming down to only 40 days receivable. So that is in, I think along with the industry, it is almost same. And there we are already seeing a lot more efficiency. So I think over next 2 years, as we recover all the old receivables and as we move out of the project business, you will see a further substantial, apart from improvement which you already see, you will see a further substantial improvement in working capital. And this is going to allow us to continue to grow the business in future. So we already have production capacity, and in the new model, we do not require a lot of capital, right? So whatever free cash flow then we generate can be used for deleveraging. That is the thought process. But at the same time, underlying business has, good momentum to positively grow, on a multi-year basis. And our product and services are really liked and loved by our customers, the farmers. As long as Jain brand products are available in most of the areas, those consumers would not like to go and buy any other brand. So I think that's what our focus is, to continue to reinvest in marketplace and consumer connect, we service the farmers. And at the same time, use production capacities efficiently. And the third part is continue to focus on dealers so that we continue to lower the working capital cycle and generate more free cash flow. I think this is where we are. I believe this kind of covers how we saw what has happened in the quarter and where we see remainder of the year. So positive momentum, good tailwind, and we are looking forward rest of the year with the same level of enthusiasm. Thank you, and we'll be happy to take any questions which may be there now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use answers while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Nishit Master from Axis Securities. Please go ahead.
Yeah, thank you for taking my question, and congratulations on good numbers. So my question is on the plastic division, because that's where we've seen growth coming in this quarter. Two things over here. One, on the Jal Jeevan Mission side, what is the kind of working capital cycle which we are witnessing? And two, on the pipes business, from the 33% odd growth, if this is a volume growth which we are mentioning, then if you could divide between existing distributors and new distributors, what's the kind of growth?
Okay, so I think your questions are two parts. One is on MJP and JJM side. I think overall receivable cycle is about 2 months, 60 days.
Okay.
Partly business is secured by LCs when we deal with other contractors and institutional suppliers and so on. So that's about 2 months. Now, in terms of, as I said, our retail business is that we directly collect advance before we ship the goods on the retail side. The 33% which we have mentioned in our release is direct retail sales of the PVC pipes. And there still most of business is coming from existing dealer distributors. The new dealer distributors, to be honest, we are not still capturing that new versus old, because some of where our existing distributors or dealers who had gone away and are coming back now.
Okay.
During this 2-3 year period as we're gaining back market share. And some of the existing dealers are really moving strong. So for example, Maharashtra dealers, just to give you an example, last year, between pipe and drip, they do combined sales, right? Last year for March 22 business, we had only 93 dealers who did more than 1 crore rupees. This year in March 23, we had 209 dealers doing more than 1 crore. Okay. So I think that's a quality, what I'm very enthusiastic and optimistic about. That quality of this business and this new business we're getting is very good. That shows a lot of loyalty, a lot of commitment from the dealer base, and consumer preference for the Jain brand.
Okay. So in this 33% growth which we are talking of in PVC pipes to the retail business, is this volume growth or value growth? And if it's value growth, then what is the volume growth? Because then ideally volume growth would have been far higher.
Yeah, value growth. This is value growth. So now when I talk of pipe domestic revenue, let's say both PVC and PE pipe combined, so what we are talking is about 46% growth, right? In the pipe domestic revenue. Last year it was 200 crores, now it is 300 crores. So almost 46% growth. Now, and I said the institutional growth in both pipes put together is 32 crores to 250. That's about 700%. When I look at combined basis, both the PVC overall growth is volume growth actually is 96%, and in PE volume growth is 400%. But values have come down significantly compared to last year.
Okay. And this business should be looked at EBITDA per ton or absolute margin per kg, right? Or, it should be looked at as percentage margins?
It should be looked at as percentage margin because, there are two ways to look at it. We have always looked at as percentage of margin. I think industry also follows percentage of margin. So I think we came out at closer to 11%, I believe, on combined business.
Okay. And is there a possibility that this will increase going ahead?
You're asking margin or revenue?
Yeah, margins.
As we consume even more capacity in the busy season, I think in those quarters you will definitely see even better margin.
Okay. So that's it, sir. And on agri or high-tech business, our sprinkler, our drip and sprinkler business has not grown, especially in Maharashtra. Any particular reason for this, sir?
No, there were certain seasonality issues in Maharashtra and how the government scheme gets operated also, even though we don't deal with the government. But overall business has grown 20%, right? So I think one state has not grown in a given quarter. And again, I have said that let's not measure the company or a particular business on a quarterly basis. On annual basis, we expect strong growth from Maharashtra. But we had very good growth in South, in West, even in North, as well as East in terms of retail. So overall, we have ended up 20 because Maharashtra has, larger, I would say, footprint. So if it is not grown in a given season or a given quarter, then overall growth comes down. But retail has overall grown 20%. You see other irrigation companies, I don't think they have that kind of growth. So our people have done quite well there. And I think for the whole year, we are very bullish on the irrigation business.
Okay. So, and on liquidity front, have the pressures decreased in terms of from the company side, in terms of liquidity being there to buy material, to buy agri-produce and all?
I think we are still running a very tight ship. But the fact that we have grown 30% without borrowing any new money, right? So that shows that things are definitely improving.
Okay. So, thank you and best of luck for future.
Sure. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to one or two per participant. Should you have a follow-up question, we would request you to rejoin the queue. Thank you. Our next question is from the line of Gaurish from JHP Securities. Please go ahead. Mr. Gaurish, your line has been unmuted. Please go ahead with the question.
Hello. Am I audible?
Yeah.
Yes, sir.
Yeah, sir. Thank you for the opportunity. I've got two questions. First is, how is the company planning to achieve the top line guidance of 30%? So if you could give us the breakup of expected growth for each segment. And also, the second is, what are the expected margins for each of the segments?
So, when we look at the growth, we are definitely expecting all divisions to grow, at a standalone level as well as Concall level. Primarily, domestic-driven growth will be there into the company, as I already explained. You saw the plastic business in India has grown more than 100% this quarter. We have good order flow, good momentum. So we would expect to maintain a very high level of growth in plastics. Irrigation business would continue to grow stronger double digits. As far as India is concerned, I think overall last year we did a 3,600 crore revenue all put together. So we would be adding somewhere close to about, I think, 1,000 to 1,200 crores to that. And, a lot of that growth will come from, plastic business, and some of the growth will come from the MIS business in totality. Now, while in MIS business, what is going to happen is that our retail would grow substantially more, but the project is going to actually, there is a degrowth in project. So overall growth you would see as a division would be less than the new business which we are doing with the retail customer and the dealers. While in pipe, projects are very limited, and they would match the last year. So there is no degrowth on the project side, which will impact the overall growth. So I would say that, MIS would kind of look at overall 20% plus type of growth, and that would be including the negative growth on the project. That means the retail is going to grow even more. And the piping, we expect even significantly more growth. Food, as I said, first quarter has been, almost nominal growth, but overall for the whole year, we expect double-digit growth. As our business is seasonal, it gets impacted with what happens in the marketplace. So I'm unable to give you a precise figure where the growth is going to come, but we are confident of meeting this number of 30%. But within that, as a weightage for the growth, more is plastic business, followed by MIS, followed by overseas plastic, food business.
Okay, sir. And secondly, sir, on can you give us a guidance on the segment-wise margins that are expected for this year?
I think we are targeting overall margin at between around 13.5-14% for the whole company. Broad range would be that we should achieve an EBITDA between about 900 and 1,000 crores. And the high-tech business, we expect to maintain around, the 17 to 18% range, while plastic we expect to move towards, it is around 11, so it is between that 12 to 12 range. So it is a little bit higher range, 10 to 12. High-tech would be between 17 and 18. And the food business, we are looking at also between 10 to 12.
Okay, sir. That's it from my side. Thank you and wish you the best luck.
Thank you.
Thank you. Our next question is from the line of Sumit Bhalotia from MK Ventures. Please go ahead.
Thank you. Congratulations, sir, for the good set of numbers. My question on the plastic business and overall guidance you've largely addressed in the last two questions. So, sir, to start with this, there's a reasonable seasonality in your business. As you said, that second quarter is typically the lowest. So historically, we have done a split of 40-60 in the first half, second half. Should we assume the similar split for this year?
Yeah. So if I look at India business, that's absolutely true. So when I look at our internal budget targets, right, we have done about 22.5, 23% of our annual budget already in the first quarter. And we will do 18% another in the second quarter. So 40-60 should be maintained. It can be again plus minus another 2%. It could be 38 or 42. But I think, July has been still quite good despite the rains all over. And, in the June there were no rains. So that also partly changes. But July has been good. We are, going good in the last 7-8 days in August. So I think momentum, that while this is a weak quarter, but we will be definitely doing far better than the last year.
Sure. So out of this high-tech revenue of around 540 crores that you have done in this quarter, what is the number for the project business? You mentioned it's degrowth 50%. So our order book today is pretty low, right? It's around 400 crore, if I'm not wrong,
right,
on a Concall basis. So the impact of that would become very nominal going forward. So if you can just give a split of, say, the project business contribution by year end, so basically the relevance of that business would keep coming down. So it will give us a good sense.
Yeah, I mean this quarter, right? Last year we were close to 150 on projects, and we are now 72, right? So it is come down by half in this quarter. But overall, last year we did 638 in the project for MIS. Year before we had done 420. So. As I said, as against 638, this whole year, I think we will be a little bit less than 400. So that much of 200 crore reduction is going to happen because of project business in MIS compared to last year. And we need to build that up and some more to have positive growth in MIS business overall. And that we are sure.
Thank you, sir. Mr. Sumit, may we request you to rejoin the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Sanjay Kohli from Goldstone Capital. Please go ahead.
Thank you. Congratulations. My question is on Rivers. Would it be correct that the carrying cost of the investment is around 1,200 crores, and this would be a significant undervaluation to what Rivers itself is worth? And, any conversation that is going around over there in terms of some fresh financing, which is saying, because they are a significant investor, could you throw some light on, basically what's going on at Rivers and Rivers' business? And in fact, we were going to be exporting to Rivers also. So what were the exports this quarter for Rivers? Thank you.
So, as you rightly said, Rivers, as a company, a combined company between us and them, and we are a lower, lesser shareholders at 18.odd% shareholding. Rivers for us, as a company, we have invested. I think we invested about, $137.5 million approximately to retain our stake as a part of the transaction where we repaid a large amount of overseas debt of 2,600 crores. And now the merge co is working and operating. But it is going to be, for the merged company to function, to continue to grow, and eventually we expect significantly high value than the stake which we are carrying into Rivers. But, it's not something overnight it will emerge. I think last 6 months, overall the international business has been challenging for everybody, not just Rivers, because of a high interest cost or high fertilizer cost in the economies in which they operate, US, Europe, Brazil, Mexico, etc. Overall both the companies combined together have solid, I think product line, very good reach to reach out to customer. So I think by next year, they will start really doing very well. And then eventually, the company is going to get valued much more than our investment. That's our belief, faith, or that's the direction we believe it should go. In terms of exports, I do not remember precisely how much we exported to them, but I would expect in the second half of the year, more export will start flowing to them, because post-merger, and I don't know whether you remember, the merger took place only on end of the last day of the March, or 29th of March. So, there are about a quarter or two we need to give to provide for, smooth working of merged company. And thereafter, we see overall exports also growing.
Okay. So the reason I asked was because in these declared results, the unallocated amounts of assets and liabilities.
I lost you.
Sorry to interrupt, Mr. Kohli. May we request you to use your handset? You're not audible, sir.
You're not audible. Okay. Yeah.
Mr. Kohli?
Yes. Am I audible?
So your line is breaking up, sir.
आपकी आवाज कम ज़्यादा हो रही.
I'm going to another window. Am I audible now?
Yeah, right, sir.
Yeah. Please go ahead.
Okay. So can we expect a sort of surprise bump up on recovery of some legacy receivables this year? I mean, since we are trying to sort it out within this financial year. And obviously then the asset turn ratios and all will become much better.
I would say you would see good bump up within about an 18-month period. Whether it already happens by March, whatever happens by March would be good. But 18 months is our target, where you'll see a major resolution of the legacy receivables, especially coming from projects.
Okay. But since Q2 is going to be slightly soft on the plastic side, will the overheads, which were this quarter in the region of about 320, will we see more efficiency there on that side as well?
Yeah, that's how naturally business will flow. But still, it will be better than the last year, but it cannot be as strong as the first quarter.
Right, but we are looking towards a reduction in the overheads. So, because the plastics business on PVC and polyethylene have become so strong that from a comparison point of view, then, we can start looking at benchmarking with other downstream polymer players to look at some of their margin metrics. That's the question.
Yeah, but, so overall we still operate as one company, but you have a valid point. Going forward, I think, plastic division could be compared with other companies which are in similar business. But again, some of them are more focused on the plumbing side, which we are not, which we hope to build on, next 2 years into that business as well.
Thank you, sir. Mr. Kohli, may we request you to rejoin the queue, please? Thank you. Our next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Hello?
Yeah.
Thank you very much for the opportunity and many congratulations for a great set of numbers. So I have two questions. First is, you mentioned in your opening remark that as we pick up scale, leverage benefit will ideally play out, right? And that will help your EBITDA margins. Now we have given an outlook for this year, but I just wanted to understand over the next 2-3 years what sort of aspirational margins we might be looking at.
So, let's look at the range, right? So I think high-tech agri, we have been, range is 16 to 18. The plastic business range, in the past, if you really see history of company, we have been 6 to 8. But right now we are targeting 10 to 12. So the idea, over next 4 quarters or so is that this 12 and 18 becomes definitely in hand. Rather than you are having 10 to 12 and 16 to 18, you become 12 and 18 definite. And then you try and see whether you, with the value-added products, for example, in plastics, as we do more plumbing, etc., can we move from 12 to 14 range? And as we grow tissue culture business, apart from the MIS business as a high-tech agri division, can we move from 18 to 20, as a range? So I think that is a direction we want to go, and that much of play exists in fixed cost of absorption as we use increased capacities over next 2 to 3 years.
Understood. So that effectively means that 13.5% to 14%, a 200 basis point jump, we can assume as you kind of move towards the fixed cost absorption, right? So maybe 15.5% to 16% over next 2-3 years.
Yeah, out of standalone business, India business.
Okay, understood. And my second question is your interest cost. I mean, you did mention about 600 crores of debt repayment this year. And I think in the current quarter, our interest cost was around 105 crores. So on an absolute level, what sort of interest cost we are looking at for FY24 and next year, FY25?
So this 105, what you see is about 15 of that is more of a book entry rather than actual interest cost.
Yeah, because of NCDs, right?
Yeah, because of NCDs. So real interest cost is about 90. So out of 90, about 60 crore is that with the, the main company, Jain Irrigation. About 20 odd crores is with the food, and then remainder is, 6-7 crores with the overseas plastic business. So that's the breakup of that. What is being repaid this year, based on the, restructuring agreement we had with the banks, the repayments which we make, which is, let's say, about 200 crore, term loans, that would mean those are costing about 9.6%, right? So that much of reduction you can see in interest. But some of other debt being repaid in the current year would be debt related to NCDs, which are 0%. So that will not result into immediate reduction of that interest cost.
Okay, so 200 crores, around 9-10% would be about 20 crore savings, right?
Yeah. 20 crore saving will be there for 24, and for year after another 200 crore at least reduction will be there. This is just based on the normal cash flows coming out of the operations of the company. If we have any other event through which we can further reduce, that would be a different story. But in normal course, you should see 20 crore reduction every year just based on the scheduled repayments related to term loans in main company as well as food companies.
Thank you. Mr. Podar, may we request you to rejoin the question queue, please? Thank you. Our next question is from the line of Devin Choksi from Head Choksi Advisors. Please go ahead.
Thank you for giving me the opportunity. Manishji, congratulations. The numbers are looking impressive now and convincing as well. Couple of points to add to the dialogue that I think we are listening. Maybe I think the overall picture of the company eventually, now that I think all the balance sheet issues are behind us, and probably I think we are having relatively better time going ahead as far as business situation is also concerned. What is the outlook that we are seeing hereafter as far as I think the growth is concerned in respective areas of activity, and particularly the one important subject I think which is our subsidiary, which is the food business. Where exactly are we seeing the higher amount of leverage of the growth coming in that particular area of business? Maybe some other points, but later.
Sure. Thank you, Devan. In terms of growth, I'm very bullish about the growth because, again, the total, if you look at overall in India agriculture and where farmers are and so on, these value-added solutions which we are providing are being implemented only about 10-15% of area. So there is a long way to go there, and more farmers who are doing this value-added agriculture, fruits, vegetables, spices, plantation materials, and all of that, they see good value in investing into these product solutions technologies. And they make money, right? You see some stories of tomato fellow making crores of rupees and so on. Some of those are actually our farmers, right, who have made crore rupees right now. And we have so many banana farmers who are now crore-patis, etc. We have pomegranate farmers. We have farmers which are growing, capsicum or other things in their small greenhouses. And a lot of these farmers continue to reinvest into farming, make it more a business-like. And that is where we really see, because of our technology, our deep reach, and full knowledge of sowing to harvesting with the farming level. And now as we increase geographies, there is going to be a very good play. And this is just in the value-added horticulture space. I'm still not touching the more of the wheat and rice part, which is agriculture part. And there also, I think, look at the climate change, right? That would be a new demand shoots available and possible. But just based on the horticulture-linked growth, we are very positive, medium to long term, to maintain a very good momentum on growth in irrigation side. On piping side, the whole country is exploding with the infrastructure growth, right? So more and more pipes are required. Right now it is led by more Jal Jeevan Mission, but also, the farmers are investing into, because everybody wants to do more value-added agriculture, therefore they need access to water or irrigation post-rainy season. And that's where the piping business is, right? And we are still not touching the urban area or plumbing or residential buildings. So there are different growth avenues possible, and that because production capacities are same, we need to just build some more muscle into the distribution in urban areas, and that's the process which is ongoing. It takes about a year or two to build that whole ecosystem, and then you really grow quite well in that context. You talked about the food business. Again, due to overall financial difficulties we face, which are behind us now, as you know. Our capacity utilization was down and so on. But some of our customers, right, who are in beverage business and so on, they see huge consumption growth. One of the major manufacturers of the juices last year grew 50% and more. As you know, there is this revenge travel happening post-COVID and whatnot. So our end consumers are, doing well, growing well. We have also export market for those products. In food, honestly, we could be doing more if we had, more adequate working capital, etc. So as now main company sorted, we are focused now onto the food business going forward to solve some of its issues related to capital and structuring. And as that gets solved, the demand is not an issue in the food business as well. We have good capacities, we have good sourcing network, we have deep relationship with the farmers. So each of business, vegetable dehydration or fruit processing, we see more growth coming from. Tomato could become a much larger product for us. Right now it's mostly mango, banana, guava, but as more Indians are eating the ketchup and sauce, the major manufacturers, we are working with them so that we can supply them more tomato paste as well. So, we are in good space in terms of technology, production capacity, relationship, supply chain to cater to the demand, and demand in each of product line, we are quite bullish.
So thank you for explaining details. One point, where exactly the capital requirement is there now, and those capital requirements, if that gets arranged, then probably the growth is definitely possible, as you have indicated. Is there any plan for any kind of a fundraise or any kind of a capital raise so that I think this particular situation can be easily handled by the company?
Yeah, I think there is nothing significant being planned because, again, focus is right now more on doing things out of the operating cycle of the business, right? So we talked about this repayment this year mostly comes out of the overdue or legacy receivables being collected or some surplus assets which are there, like some land, etc., which are not required in the business by monetizing those. Those kind of efforts which we have. But there is no immediate plan of any significant fundraise. There could be here and there a little bit, but nothing, structurally, immediately. I think our focus in the FY24 is to focus on operating metrics. FY25-26 could be different issue. But again, overall the idea is that business should continually build itself so that the ROA, ROE, all of this debt to EBITDA, every single ratio continues to improve dramatically from where it has been.
Thank you, Anilji.
Thank you, Jainbhai. Order to sell, you will find that we are definitely equal or better than most of the peers into the businesses we are in.
So assumptions of what is the utilization in assets and what is the way forward to improve the ROIC? Is the way forward to improve the ROIC going to come out of working capital cycle in the high tech?
Yeah, I think the capital invested, for example, legacy receivables, right, almost to the tune of 600-700 crores. As that flows back over next 18 months back, then that much of capital employed will be not required. So the idea is improving ROICs through more sale to the dealers, where working capital requirement is much lower, right? We are almost selling against advance. So I think different segment of the market in which we are focusing and recovering old legacy receivable combined effect will give you significant improvement in ROIC.
And what is the asset utilization?
Sir, it varies, and in some of like MIS business is very difficult to measure. But I think we are now hitting, in full quarter, we are hitting about 50 to 60%, somewhere around that. So there is another 2.5 years of growth at these levels we can maintain without any significant growth capex.
And what is the share, what is the dealer business or the retail business in both these segments, the extent of retail as a percentage of sales?
So I think if I look at MIS domestic revenue, out of total sales of about 430, retail is 340, so quite a lot. And
sorry, I didn't understand. Out of 430, 330.
Yeah. So in piping, it's about close to 50%, but in irrigation, it is close to about now 70-75%.
Okay. And last, when you said you will not need a capital raise, so will you be able to grow your business with repayment of debt and no equity fundraise?
So I have said that there is no plan to do. I cannot, unless things happen, I can't be discussing about, particular event related to fundraising. But structurally speaking, we are not planning to do any significant equity raise. Definitely not.
How about debt?
As far as debt is concerned, we have already said this year we are planning to reduce debt by 600 crore while still growing the business by 30%.
Okay, so this year is 600 crore debt reduction on a 30% top line growth.
Yeah.
Okay. And your capex needs, because you said you have 50% asset utilization, so which means you need maintenance.
It's not exactly 50, but we are right now doing maintenance capex. We might need some growth capex, which is linked to certain product lines. For example, as we do more plumbing, we might have to invest into some capacity related to fitting. Or as we increase the tissue culture business, there we might need capacity. But for our traditional business of drip irrigation or PVC pipes or polyethylene pipes, we have enough capacity to over next 2 to 3 years where we don't have to put any capex.
Thank you. Mr. Chela, may we request you to rejoin the queue, please? Our next question is from the line of Ram Narayan from Swarcon. Please go ahead.
Hi, thanks for the opportunity. I just wanted to ask relating to the debt reduction, because last year I think it was said that around 500 crores will be reduced, but when I saw the repayment schedule this year in the presentation, only 100 crores has been, around 130 crores has been shown. So I just wanted to know what it's looking like.
No, so as you know, we have gone through restructuring with the banks. So some of these NCDs which are there, which are due in 27-28, but they needs to be repaid as we recover the legacy receivables. That is the understanding with the banks. So that is where repayment will happen. And we already repaid some in the first quarter, and that is how the remainder you see in the remaining 9 months.
Okay. So based on the legacy receivables, you might be prepaying NCDs as well.
Right. And some asset monetization, a combination of legacy receivable and asset monetization. NCDs would be brought down. And while what we repaid in the first quarter and the remaining 131 you see 9 months, so that is how that total 600 happens.
Okay, thank you. And another question would be like the promoters pledging was very high in the last quarter, so it was said that they are planning to reduce it. So what is the plan regarding that?
So that I have said that over 12 months, right? So I think it would happen. You will see, but we have to wait for a few quarters. At promoter level, we are trying to, do some value monetization on promoter assets, which I believe should result in, creation of funds which would help us, enable us to repay the loans and free the shares. So when I made that commitment, I talked about the over 12-month period, and it will happen during that period.
Okay, thank you.
Thank you. Our next question is from the line of Tushar Sarda from Athena Investments.
Yes, thank you. Thank you for the opportunity. I wanted to know about your food processing business. How much is in India and what are the margins? And overseas, how big is the business and what are the margins? 100% or is there a partner?
So overall business, majority shareholding is with Jain Irrigation. And we have investment from a private equity Mandala agribusiness into the food business. If I look at overall food business, so we have standalone India business, which is quite there. And then also we have the overseas business, which is there. So, we currently, in terms of margin into the food business, when I look at overall EBITDA, about 50% is coming from the India piece and the 50% is coming from the overseas piece in that.
Thank you, sir. Ladies and gentlemen, that was the last question of our question and answer session due to time constraints. I would now like to hand the conference over to management for closing comments.
Yeah. I think we have a good session. Overall, just to complete last question, agri and food, overall EBITDA was also about, I think, 13%. And out of total 440 crores business we did in the current quarter, about 170 came out of India and 270 came from outside India. And as I said, the overall EBITDA was roughly split half-half between both of these entities in totality. And overall it came at closer to 13%. Okay. So, I think, where we came from, the worst is behind us for sure. We are discussing now growth, sustainable growth. We're discussing deleveraging, and we're discussing how do we keep focusing on improving businesses where working capital cycle is much shorter and use more and more capacities so that ROIC can continue to improve. And again, it's not something every quarter you see because of seasonality, but structurally, I think when you look at FY2024-25 compared to last few years, you will see a qualitative difference in terms of the balance sheet and underlying business metrics and business performance. And overall, I think business and industry is moving in positive direction. And people working inside the company, our dealer network, our suppliers, everybody is enthused and fully supportive of where company stands. So I think we are moving forward in a right direction with a very resolute mind in terms of how we want to achieve what we want to achieve. And we thank the market participants, shareholders, analysts, and everybody else who would also support us in this journey. Thank you.
Thank you. On behalf of Jain Irrigation Systems, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.